that? Oh, I don't know, Angelo. Maybe. Anyway, we will start over. So, anything you hear today is general advice. I don't know anything about you. That's Will, by the way. I don't know anything about you, so I can't offer personal advice. You can go to our website, morningstar.com.au, to get a copy of our FAP if you're over in New Zealand, or if you're just interested in it and you're not in New Zealand. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. So sorry about those issues. I blame it on Will, because I think it actually was his fault that he forgot to turn on the microphone. So I think that is casting blame in the right direction. We're going to talk about investing myths. But obviously, if you have any questions about anything that's happened, let me know. We saw a wild day in US markets and just a down day in Australian markets. So I woke up very early this morning. I looked at my phone to see what was happening in the US, and the market was kind of down moderately. I went to the gym and I got like the notification that the Fed raised rates. I looked at my phone and the market had gone up, and I thought, oh, must be really good news. I must have said something in the statement. And then I don't know if anyone's seen what happened, but then markets went the other direction as soon as Chairman Powell started talking. So interesting day. But anyway, any questions you have, go ahead and ask them. All right. We are going to talk about a couple myths. So the first myth that we're going to talk about is active investing. So over here, active, that is Michael Scott. He is running in the rabies race for the cure. So that occurred, if anyone watched The Office, after Meredith was bit by a bat. I think she was also bit by a raccoon and a rat, and he instituted a fun run. So there he is, being active. And then this is, of course, Jabba the Hutt from Star Wars. Not very active, giant slug type person. I don't really know Star Wars that well. Maybe I'm wrong. We're going to talk about active versus passive investing. So, of course, active investing is somebody or something, a computer or an algorithm, is making decisions on what you actually buy and put in portfolios. Passive, of course, is just tracking an index. Now, there has been a very, I'd say over the past 20 years or so, a large swing from active to passive, and it kind of accelerated after the GFC. And it accelerated basically because from kind of the GFC until basically this year, we saw the same types of companies, literally the same companies, not the same types of companies, same companies do very, very well. And what we saw do very, very, very well was large cap, so big companies in the US that were sort of technology, either in the technology sector or kind of technology adjacent. So things like Amazon, for an example, which is a retailer, of course, but many people, obviously because it's all online, many people sort of think of that as a technology company. And then companies that actually sit in the communication sector like Google or Alphabet and Facebook did very, very well for a very long time. And this was a very good environment. If we think about the way that indexes are structured, when companies do better, they of course become larger parts of the index because they're market cap weighted, which means bigger companies take up more of the index. So when you get in environments where it's the same companies that do really, really well year after year after year after year, it becomes very difficult for active managers to operate. And basically an active manager, whether you're a global manager, whether you're a US manager, a lot of these managers, if you did not have these shares in your portfolio, you underperform the market. It was kind of simple as that, right? Because when the largest companies in the index are dragging it up, and they were essentially dragging it up, and they were doing much better, the index was doing much better than the average company in the index, because those big companies are doing so well. It's very, very difficult to beat the market as an active investor. So what happened? It sort of accelerated this trend that we've been going through with more money flowing into active. And, if you look at sort of the percentage, it went from something like, 25, 30% of all money invested in the market in passive funds to over 50%. So we've seen this huge surge into passive. And of course, because a lot of the passive managers were struggling, number one, to gather assets, number two, to beat the market, you, of course, got this proclamation that active is dead or dying. But a couple of things that we need to think about. This story with global indexes, people have probably seen this chart before, and I'll get into it in a second. The story with global indexes, and global indexes, once again, they have become, and we'll get into this in a second, dominated by the US, right? The US makes up over 70% of a developed market global index that has something like 22 different countries in it. But basically, it was a US story. And once again, basically, it was a technology story. All these names you hear about all the time, Apple and Facebook and Meta now, and Alphabet and Amazon and Microsoft, all these names drove the market higher and higher and higher, drove the US market share up more and more, to the point where Apple as a company is worth more than all the companies in Australia. And you get to this point where, yeah, it's very, very difficult to beat US large cap. And this chart is showing the percentage of active managers who beat the passive index over the last 10 years. So I do show this chart a lot, and a lot of different reasons. So yeah, it's very, very hard. It's very, very hard in this last 10-year period to beat large US shares. Also very difficult, although a little less difficult, to beat foreign large blends. So basically what that means globally, they're dominated by the US. But anyway, what this chart indicates is a percentage of active managers who beat their passive index. But just wanted to point out, there are many areas where active is still something that can be effective and has been effective. If we start looking at these emerging markets, for instance, a lot of these less efficient markets, real estate, junk bonds, high yield bonds, and even most of the bonds. So there are still opportunities for active to beat the market. Yeah, that's a good question, Lisa. I'll get to that in 1 second. There are still a lot of opportunities for active to beat the market. And it depends also, of course, I would say about active funds is it depends what your investment goals are. So we talked about this in a previous session, but there are, of course, active managers that are trying to do very specific things, whether that's generate income, whether that's lower volatility, if that's what you're looking for. So there are certainly opportunities to go out there. So I would say active is certainly not dead. And before we get into the second myth, let's answer Lisa's question. So she says Meta is down 52%. So that's, of course, Facebook's parent company. What sort of effect would this have on active tech or index funds? Yeah, so a lot of what I was saying and that what was happening was up until this year. And then this year, we've seen a very different story. So some of these, so basically what we've happened, and the interesting way to look at this, and I should have put a chart in here, but the interesting thing to look at is how a market cap weighted index performs against a equal weighted index. So the difference being in a market cap weighted index, which is the ones we all know, right? So the ASX 200 is a market cap weighted index. S&P 500 market cap weighted index. Forget the Dow, that's barely an index and has very strange, it's a price weighted index, which is insane. But the NASDAQ, all these things that you hear about all the time, they're all market cap weighted indexes. But if you look at how a market cap weighted index compares against an equal weighted index, you can start to see the influence of these big companies. So what's happened, Lisa, is basically what has fallen this year, a lot of these big companies. And so you haven't seen great years out of Microsoft, certainly not Meta, which has had a terrible year, but you also haven't seen great years out of Alphabet, which is Google's parent company. A lot of these companies are struggling, or at least the share prices are struggling, and companies are struggling a little bit as well. So yeah, it's kind of had the opposite effect. So the interesting thing will be, like, if this trend continues, I think you're going to start to see those active managers, and they need a little more of a track record, but you can start to see those active managers potentially outperforming. And this very easy trade that people could do, go buy some very, very cheap index product and watch it go up 13% a year for a decade. Like, that's not going to happen anymore. Potentially, I don't know what's going to happen, but I don't think it's going to happen. And it'll be interesting to see if that is the shift as well, because I think a lot of people have attributed passive and the amount of assets that passive funds have gathered, I think a lot of people have attributed that to all the stuff that Bogle used to say, right? Like it's better from a tax perspective, it's better from an expense perspective, and all of that's true. But I think a lot of those assets are also just because the returns were so strong. There was no need to go in and pay an active manager more, especially if they can't beat the index. So it'll just be interesting to see what happens. Investors chase performance, whether they should or shouldn't. And the answer is they shouldn't. We shouldn't. People chase performance. So I think if active starts outperforming, the flows are going to go back in that direction, but we'll see. All right. So this is Switzerland, or at least it's a picture of some nice mountains with a Swiss flag in it. And this is myth number 2. Investing passively means not taking a bet on any particular part of the market. And I think this is this huge misnomer around passive investing. And there's a couple different ways to think about it. But, you know, if I invest passively, right, the whole word of it, right, like, you know, I'm just owning the market, right? And that's what everyone talks about. But it's important to realize that owning the market, number one, the market shifts over time as different sectors and different companies become worth more and less. So it shifts over time. So you going back and owning the market, you went and bought a passive fund in the year 2000, that's a very different market that you own and can have very different characteristics than the market in 2010 and the market in 2022. Something important to remember, but let's dig into this a little bit. And let's look at a couple markets. So I updated all of these this morning. So let's look at a couple markets and what's actually in them. So first we're going to look, and I've been doing this through ETFs. So we're looking at IVV, iShares S&P 500 ETF. So S&P 500 largest shares in the US. So you would expect, I think, just from the fact that this is the 500 largest shares in the US, that they would be large cap. So we're looking at 2 dimensions here. Small, medium, large. So these are the size of companies in terms of market cap or market capitalization. So number of shares times the price. And then we're looking at value, blend, and growth. So basically what we're looking at here is we're looking at valuation metrics. So a share trading for a lower PE, for example, or a lower price to book value or anything else would be value. Growth are the most expensive shares and their blends in the middle. Yeah, so what are you getting? Well, you're getting a lot of large cap growth and now a lot of large cap blend as well. But it's just important to realize that, okay, this thing is certainly tilted in a certain direction. Then we start looking at sectors. And even with the falls that we've had in technology, you can still see that if you go buy the US market, what are you buying? Well, almost a quarter of your money is in technology, right? And we add in communication services, which most people would consider intuitively technology, right? If I went and I told you what kind of company is Google or Alphabet, most people would say it's a tech company. Well, it happens to fall in a different sector. But the point is, you are investing a lot, over 30%, in basically one sector, at least in our mind. So you need to realize that, yeah, you're taking a pretty big bet on a couple of sectors. And then if we turn to Australia, once again, you're just a passive investor. I'm just buying the US market. I'm just buying the Australian market. You look at Vanguard Australian shares, the most popular ETF in Australia. What are you getting? Well, it's very, very different. All right. You're getting value in blend, right? And growth is very, very small. And when we swing over here, I think as everyone knows, what are you getting? Well, you're getting over 50% in 2 different sectors: basic materials and financial services. So if you sit there and you think about Australia, like going in there and buying once again the entire index, you better hope China keeps importing raw materials, and you better hope nothing goes wrong with the Australian real estate sector or the Australian residential real estate, because you're getting the banks and you're getting basic materials. You are not getting technology, for example. All we hear about is technology and how important technology is. Well, you're not getting any technology. So it's just important to think about that. Just because you're a passive investor does not mean that you are not making a pretty big bet, and it will shift over time, a pretty big bet on certain sectors. And maybe you're fine with that, but something to think about. I think a lot of people, I think the problem is that a lot of people, and I'm sure nobody on here, but I think a lot of people think that passive investing and investing in these wide indexes is like, okay, well, I'm investing a little bit in everything. Well, no, you're investing a lot in certain things and very, very little to the point where it does not impact your returns and other things. And if you want to see, especially in Australia, if you want to see this impact, go look at the ASX 200 and the ASX 300. People sit there and they talk about, oh, should I go in the 200 or the 300? The 300 has more shares or more companies in it. Like that's more diversified. There's no difference. There's no difference because yes, there are 100 more companies technically in there. But if you look at the assets that are allocated into those top 200 companies, even forget them, look at the top 10, there will be really no noticeable difference between the returns. Because so little is allocated to those last 100 companies. And if you go back historically, and you look at the returns, they're pretty similar. So something to think. Rodney says Switzerland isn't neutral anymore. So are there any neutral countries anymore? I'll have to think about that. What do you think, Emily? Emily's not sure. So maybe we have no neutral country. So Phil says, I heard a comment once that I shouldn't bother with investing in discrete stocks, just buy VAS and VGS and put up my feet and watch the money roll in. Well, that would be nice, Phil. And maybe we'll see. I don't think the money's been rolling in this year. Although things have not been that bad in Australia. All right, the other thing, we're going to look at a all world. So I was referencing this before. So the MSCI World All Cap ETF. So what does this mean? So this is an ETF that tracks everything. So all cap means all market capitalization. So you're thinking, okay, this is good. I'm investing not only in the largest companies in the world, I'm also investing in smaller companies. That is great. What does this look like? We go and we look at this sort of growth and large cap perspective. And if we look at the technology allocation and communication services, what does that look like? Well, what it looks like is the US. It's almost exactly the same, just a little more allocation to technology. So you're basically getting the US, and the US, because it dominates this index, is what you're investing in. So you may sleep well at night knowing that you're investing in all of these different countries. You're so diversified, but you're actually not. And this does not mean, of course, that this will hold over time. But it's important to realize what it is now. Because, of course, if the U.S. has significantly outperformed almost every other country since the GFC from a share market perspective, certainly not from other perspectives, from a share market perspective. And so what that means is it's gotten to be more and more and more of the index. Now, the U.S. was also and is also more expensive than any other country in terms of a valuation perspective. So one would think that those returns would be lower, and that maybe if we're sitting here a couple of years from now, that there would be more of a balance. But right now, this stuff is dominated by the US. So something important to remember. All right, so I like this photo because there's a turtle and a bunny, and the turtle is winning. And, you know, it's obviously the old adage about the bunny in the hare, not the bunny in the hare, the turtle in the hare, tortoise in the hare. So myth 3, the best way to invest is to find the fastest growing company. So this is something that I think we hear, or I hear at least all the time. And this is this sort of first order thinking that seems to have dominated all discussions about investing, that if you want to invest, the easiest thing for you to do is sit there and think about an industry that's growing, or a company that's growing really fast and that you think will grow really fast, and then you just invest in it, right? This is the whole backbone of thematic investing. Climate change or gaming or whatever, electric batteries. There's all these themes, and that they will dominate the world. So all I have to do is go and invest in this theme or find a company that's associated with this theme, and I will make a bunch of money. Well, it's not actually true. So the problem, of course, is that investors pay a lot of money for growth. And the other problem is that, of course, this is all about stuff we think will happen in the future. And while we are so certain that these certain trends are going to dominate the future, they often don't. And you think about going back in history, you think about some of the giant trends that were supposed to happen. So remember, we were all supposed to run out of food. So the Earth's population was supposed to get so big that we were going to run out of food. Well, that didn't happen. Then we had this whole thing. If you go back earlier in the 20th century, it was the world was going into a new ice age. Well, that didn't happen, but there was a lot of certainty that that was going to happen. So just be careful about these things that we all agree upon, right? You know, we sit there and we all agree that, okay, all of sort of, you know, petrol powered internal combustion engines will go away and we'll all drive electric vehicles until 2 weeks from now, somebody invents something new. And this is not a premonition, but somebody could invent something new that makes that whole thing go away. It's a more efficient way for us to drive around. So just be careful about some of these trends, but we'll look at some of the individual company stats. Good question by Eric. Good question by Eric. So before we get into this, all right, here we go. This is never going to go well. It's me trying to do two things at once. So what we can look at is, I'm going to go onto our website to answer Eric's question. So Eric's question is, what percentage of markets are China and European markets? Well, the simple way we can do this, the answer is not a lot. Simple way you can do this, and I'll share my screen in 1 second, so don't worry. Simple way you can do this is go in and look at a breakdown of the portfolios of an ETF that is tracking that's tracking one of these wide indexes. So let me share my screen again. All right, so I'm looking at this same product we were talking about before. This iShares Core MSCI World X Australia. Oh, now they've changed the name, of course, to ESG Leaders, because iShares is going through this whole new branding. But anyway, IWLD we were looking at before. So I can go in here and I can say, okay, region perspective, where are things allocated? Well, very simply, 11.86% in Europe. So combined, we want to include the United Kingdom in Europe, which they certainly do not want to include themselves in. Then we're just about 15%. If we go into country, we can start seeing, 73% in the US, and we can start seeing the individual companies. So yeah, not a lot is the answer. One thing I would say about China, so while China doesn't generally place anywhere close to the top of a lot of these things, China does dominate any emerging market index. So remember, with emerging markets, you can't really graduate out of emerging markets into developed markets. Like there's kind of a naming convention issue here that you would think at a certain point you would get out of emerging markets, you moved into developing markets. But it's kind of like if you're in there once, you're not leaving. So there are countries that certainly from any any evaluation, so whether it's Taiwan or South Korea or Israel, you're looking at living standards, you're looking at GDP per capita, like these countries are developed markets, but they are still considered emerging markets and they're never going to get out of there. So if you look at a lot of emerging markets indexes, you can see that China dominates them. So it's the other thing to think about, that if you are investing in emerging markets, you are investing in China. So think about that with indexes. It's another one that I could have shown on here. Where are we? There we go. Now, not to the degree of the US, but look, 27% is in China. So that's a lot. So yeah, we go down this list. Some are very emerging markets, some certainly are not. All right, let me go back to my turtle picture. We've got another question from the anonymous attendee. One of my issues with don't time the market right now is that if you're an index investor, it seems like rising interest rates will change the investing climate so much. that the broad indexes are likely to change a lot. So probably best to let this work through a bit before investing in index funds again. Yeah, I mean, I think the question, like, I think that's a really good thought, but the question is like, how will you know when this has worked through a bit? That's kind of my only question. Like we seem to be in this situation where, and I was saying to somebody saying this morning, is like people, like the market seems to just want to believe what it wants to believe. Like if you go back there and you look at the Federal Reserve, for example, because they had such a big influence on what's happening today, go back there and look at the Federal Reserve. In my mind, they've been very consistent. As soon as they kind of clued into the fact that this is not transitory, I think they've been very consistent about, we're going to keep raising rates. We don't care if we hurt the economy. We're going to keep doing it until inflation stops. And what seems to happen is, like, every couple of weeks, the market decides that, oh, okay, like we interpreted some weird little like sign, some little comment that somebody made as they're not going to do this. And we're at a pivot point. And then, of course, something like today happens where, I think the same thing happened, right? So the Fed raises interest rates, they release a statement, and market participants read that statement and decide that there's something in there indicating that things are going to pivot again. And then literally there was a press conference and Jerome Powell stood up there as the chairman of the Federal Reserve and was like, we're going to keep raising interest rates until we crush inflation. And then the market freaked out and went down 2.5%, or the NASDAQ went down more. And it just seemed to me, it just seems like it's all this wishful thinking. But I think the question is like, yeah, when will you know when you can invest in index funds again? But yeah, I think if interest rates keep going up, valuation levels will keep going down. I think if inflation stays high and they can't get it under control, it's going to be challenging for companies. So I get all that. It's just like, when are you getting back in? All right, let's keep going. So we're going to look at this idea between growth and investment return. So I picked a couple different periods here. You can see here I picked 1972 to 2013. Two companies, IBM and ExxonMobil. So IBM, well, people forget it now, used to be the biggest and leading edge technology company. ExxonMobil, of course, has been around for a very, very long time. The old Standard Oil, breaking up the monopoly, it's been around forever. So if we look at this period between 1972 and 2013, what would you suspect would happen? Well, that was a time of enormous technology change, and IBM was at the forefront of a lot of this. So, how many people had computers sitting on their desk in 1972, right? Nobody. Well, look at the returns. And why are the returns so different? So this company who's just pumping oil out of the ground, and obviously oil prices have gone up. Then you look at IBM, who's revolutionizing the way we think about technology, right? And look at the two differences. So the point is, and we'll have another example. We'll go through the other example too. We're going to look at Philip Morris, same period. So MO, that's actually Altria, but Altria used to be this global tobacco giant. They split up into different companies, international and US. But same thing, like smoking, I think smoking peaked in the US in 1969, basically a horrible period for tobacco companies, maybe not for everyone's health, but where there were lawsuits and lawsuits and lawsuits. They had this huge settlement with the federal government in the US. You saw advertising bans. You certainly seen really, really high taxes put on cigarettes. And look at how Philip Morris performed versus the S&P 500. Pretty good. And the whole point of this is that low expectations, you have to understand that expectations for the future are always built into share prices, right? Because you're buying a share for the future. and that low expectations are a lot easier to beat than high expectations. And things like dividends matter. And all of these different components of returns that we like to discount because it's more exciting to go chase the fast growing story that you like to talk to your mates about, it doesn't necessarily translate into investing success. And even if we look at something like, I can go back to the website. Even if we look at something like Tesla, right? And like Tesla's not had a great year. But we can go look at Tesla and we can look at the valuation level that it has been trading at. And I'm not saying that Tesla will not turn into this wonderful company, but if you go and you look at just from a valuation level, go look at like how expensive Tesla was, and it's come down a little bit, but still is. We looked at price to earnings. Now, of course, it didn't have a price to earnings because it didn't have any earnings. But if we sit there and we look at where it was the last couple of years, 2020, so this represents the last day of that year. So trading for 1,300 times earnings, 343 times earnings, it's come down a lot now, both because earnings have grown and the share price has come down. But all I'm saying is that there's a lot of expectations baked into these really high price to earnings ratios. And we have to realize that the company doing very, very well doesn't necessarily mean the share price is going to do well if it doesn't exceed those expectations, right? So it's very important anytime you buy a share to understand what the market thinks is going to happen. So if the market thinks the company is going to grow 2% a year and they grow 4% a year, then that is great. And that share will probably do very well. If everyone thinks Tesla is going to grow 300% a year and they grow 250%, it's going to get hammered. So it's just important to understand those expectations, and that fast growth is not necessarily the thing that drives share returns. All right. Am I still sharing? There you go. So I have a comment from Rodney, which is right, that China is not on there because it's not a developed market. Yep. So China will forever be stuck as an emerging market, just because, yeah, people don't graduate from that. So anyway, well, that's all we have today. But if there are no more questions, I will just sign off and give you all 25 minutes back in your life. Emily is very excited about that. She can barely stay awake in here. Emily earlier was eating lunch, so I think she wants her post-lunch siesta. But anyway, thank you guys very much for joining. I appreciate it. Shoot me an email if anyone has questions, mark.lamonica1@morningstar.com.